oil prices are still grappling with the fundamental fact that the Strait of Hormuz is still largely closed and presumably will remain largely closed after that deadline. I don't think anything fundamentally changes for the oil market, apart from the fact that this conflict will continue to seem intractable. If Trump follows through on his threat, however, it will be an enormous escalation, especially given the threats that Iran has made to retaliate against assets across the Gulf, including energy assets, and it will make a resolution to this conflict seem further off. So in either scenario, unless Iran capitulates and says, yes, we're going to open the Straits, which I don't think anyone expects based on what we've seen from Tehran so far, it's a question of will oil go a little bit higher or a lot higher.
Yeah. OK. And it is going a little bit higher at the moment, isn't it? Well, I mean, given the equity markets seem to be responding as if we got a lot of new information over the weekend, and a lot of it was negative. US futures pointing down by, well, it was just shy of 1%. Now a little better than that, but still pointing quite negative. Oil prices just making very modest moves to the upside. But interesting on the Brent curve, if you look further out the curve, actually, we seem to be seeing more response and prices going higher further out the curve over the next year or couple of years. Does that give us a sense that maybe the market is increasingly thinking about the longer-term impact of this?
I think if we look at the market reaction across the board today, clearly it's about pricing in the fact that this conflict isn't going to stop anytime soon, and even if it does, there won't be a clear and quick resolution to the problems that we've seen build up through the global energy system over the last few weeks. I think many traders at the start of this conflict thought it would be short-lived, and you saw a lot of people trade oil on that basis. But as we go longer, the dislocations through the global energy system get worse, and the time it will take to get things back to normal increases, which is why we've seen the sort of pricing action further out that you described, Anna.
And indeed, in terms of that retaliation, you've had Iran just threatening to mine the Persian Gulf if its islands and coast are attacked. So it's only a heightening of the rhetoric on both sides coming now. Usually, when it's Sarah week, Will, we would be talking about that when it comes to the oil market. But of course, the focus is on the Middle East. Is there anything that we should be watching out for in particular there?
It's an interesting moment for the shale industry. Obviously, these prices are allowing the shale industry to sell forward a lot of its production at higher prices. So it probably means that those concerns about production in the US that we talked about from time to time about shale slowing down, peaking, it probably suggests that it's giving the financial framework for the shale industry to continue drilling, to continue trying to exploit those resources as much as possible. So it's probably fairly bullish for the outlook. But of course, the other big question for the US is ratcheting higher of product prices. We talked a lot about diesel at $5. We've got gasoline at $4. And the economy in the US is very sensitive to these prices, especially when it comes to consumer sentiment.
Yeah, and interesting that we do see WTI moving as much, if not more, than Brent today, because last week we talked about a divergence. The
divergence was incredibly stark. We saw the spread between WTI futures in New York and Brent futures in London blow out to levels much higher than we normally expect. And there are reasons for that. Clearly, the US is more self-sufficient. It's to do with the types of crude that are produced in both countries. But there was always going to be a bit of a catch-up, and the US administration has been really keen to keep a lid on WTI prices. But there's only so much that can be done.